First, the emergency monetary measures needed to support the economy through the pandemic are no longer required, and they have ended. Second, interest rates need to increase to control inflation. Canadians should expect a rising path for interest rates. And third, while reopening an economy after repeated waves of COVID is complicated, Canadians can be confident that the Bank of Canada will control inflation. We are committed to bringing inflation back to target.
Well, everyone, the Bank of Canada Goblins are at it again, and they have decided to keep interest rates low, but not for long. So today on January 26, 2022, the Bank of Canada did another press release where they essentially decided they were going to maintain their policy rate and remove their exceptional forward guidance. So what the heck does that mean? Well, the first part, the maintains policy rate, they're talking about their target for the overnight rate. The Bank of Canada today held its target for the overnight rate at the effective lower bound of 0.25%, with the bank rate at 0.5% and the deposit rate at 0.25%. With overall economic slack now absorbed, the bank has removed its exceptional forward guidance on its policy interest rate. So basically, as you're probably aware, the interest rates have been at like all-time lows for quite a while now. And today was one of the days they were going to decide if they were raising them or keeping the same. It seemed like it was kind of like 50-50. A lot of people were expecting them to raise rates because inflation has gone up quite a bit, but they didn't. So they've kept it the same. And this is their press release. So I'm going to go into a couple highlights that I made, kind of fill in what my key takeaways are from it and what that could mean for housing prices across Canada, but also in my local market in Edmonton. And there's a couple other cool tidbits in here as well. Everybody's probably been noticing inflation with food prices and all types of stuff. So there's some really interesting stuff in this report, but also what we can take away from this on what the bank might do moving forward. So even though they've decided to keep rates the same right now, a lot of the language in their press release and in the report definitely makes it sound like it's not going to be for long. So stay tuned. If you're liking this type of content, make sure to hit that like and subscribe button. And I'll put a link where you can hop on my email list. So if you're interested in getting these updates whenever I'm talking about things that could affect the housing market in Canada and Edmonton, you can subscribe to my email newsletter and I'll email you when I've got a new video. All right, so a couple more highlights here. So elevated housing market activity continues to put upward pressure on housing prices, or on house prices. So they're admitting that there's more activity in the housing market and it's putting upward pressure on house prices. Obviously in our market here in Edmonton, it's not going as crazy as it is in some other parts of Canada like Vancouver and Toronto, but things are definitely picking up. Last year was a very strong year for Edmonton, and it's starting to look like it might be a similar year so far. All right, so one of the things that I wanted to point out, the second thing is what they said is that they removed their exceptional forward guidance. So that doesn't make much sense until you read more of their press release and their other documents to make sense of what that means. So they're very concerned about inflation is essentially what it comes down to. So here we go. CPI, which is the Consumer Price Index, inflation remains well above the target range, and core measures of inflation have edged up since October. Persistent supply constraints are feeding through to a broader range of goods prices, and combined with higher food and energy prices are expected to keep CPI inflation close to 5% in the first half of 2022. So the Bank of Canada wants to keep it around 2%. It is a flexible sort of mandate, but it's too high for what they'd like.
We said exceptional forward guidance would continue until slack was absorbed. With the strength of the recovery through the second half of 2021, the Governing Council now judges this condition has been met. As such, we are removing our commitment to hold our policy rate at its floor of 0.25%.
So basically they're telling us right now that they had a condition on them keeping interest rates low. And that was that they wanted the economic slack to kind of get tighter, I guess you could say. And they're saying that it has been absorbed. So they're kind of like warning us that they're going to be increasing rates in the near future if this continues. So it says, the Governing Council therefore decided to end its extraordinary commitment to hold its policy rate at the effective lower bound, which is just really low rates. Looking ahead, the Governing Council expects interest rates will need to increase, with the timing and pace of those increased guided by the bank's commitment to achieving the 2% inflation target. So that's what their target is. They want to keep inflation at 2%. It's at 5% right now. So the slack's been filled in the economy. So even though they didn't raise them right now, that's warning that they will. And now the next piece of important information on the date to look out for is the next scheduled date for announcing the overnight rate target is March 2nd, 2022. So that's the next time they're meeting, and they're going to make another announcement on if they're raising rates or not. Previously, the information that they had shared publicly made it sound like they didn't think that the economic slack was going to be filled until the mid quarters of 2022. And so I was anticipating that they might not raise rates until like April or later. So the next time they're meeting after the March 2nd is that April 13th. So originally I had thought that might be the earliest that they'd raise rates, but the way that they're talking in this press release makes it sound like there's a pretty good chance that it'll actually happen on March 2nd, 2022. A lot of people were expecting them to do it today on January 26th, but they didn't. So definitely gonna wanna look forward to the next one. What they also did is they also released their monetary policy report today as well. And this just goes into a little bit more detail. Well, a lot more detail, maybe not a little bit more detail. So I wanted to share some key takeaways from this as well that could be important to you, and some of the decisions you might make if you're considering buying a home and just kind of wanting to stay in the loop on kind of some stuff that's going on in the Canadian economy. First, let's review a few things about Canada's inflation control strategy. So inflation targeting and the economy. The objective of Canada's monetary policy is to promote the economic and financial well-being of Canadians. Canada's experience with inflation targeting since 1991 has shown that the best way that monetary policy can achieve this goal is by maintaining a low and stable inflation environment. So that just shows they really want to keep inflation low, and they think that's the best way to meet their goals. Doing so fosters confidence in the value of money and contributes to sustained economic growth, a strong and inclusive labor market, and improving living standards. So they're just kind of giving some more of the rationale there. So they had just renewed the inflation target at 2%, the 2% midpoint of the 1% to 3% control range, with inflation measured as the 12-month rate of change in the consumer price index. The government and the bank agreed that the best contribution monetary policy can make to the economic and financial well-being of Canadians is to continue to focus on price stability. So they really don't want prices to go crazy. People will lose confidence in the value of money. So that's essentially their primary concern. It says the primary objective of monetary policy is to maintain low, stable inflation over time. And then right here, they're just saying Canada's inflation targeting approach is symmetric, which means the bank is equally concerned about inflation rising above or falling below the 2% target. So it's not all just about preventing runaway inflation. They also don't want it to be too low or to become deflationary, because that could be scary as well. So let's jump forward a couple things that I wanted to point out in this report. So in the overview, a robust economic recovery continued throughout the second half of 2021 in Canada and abroad. Taking into account the faster than expected growth and strong job gains, the bank judges that economic slack is now essentially absorbed. So they mentioned some of that stuff before, and this is going into a little bit more detail.
Second, we want to clearly signal that we expect interest rates will need to increase. A lot of factors are contributing to the uncomfortably high inflation we are experiencing today, and many of these are global, and they reflect the unique circumstances of the pandemic. As the pandemic fades, conditions will normalize and inflation will come down. However, with Canadian labor markets tightening and evidence of capacity pressures increasing, Governing Council expects higher interest rates will be needed to bring inflation back to the 2% target.
disruptions to global supply chains have broadened and become more pronounced, pushing inflation higher in most advanced and emerging market economies. In response to inflationary pressures, some central banks have already raised their policy interest rates, and others have signaled they plan to do so. So basically, they're saying globally there's a lot of inflationary pressure, and that central banks of other countries, some of them have already started to raise their rates, and there's a bunch of other ones that have made it pretty clear that they're probably going to do it soon as well. So this is not just a Canadian phenomenon. It says the impacts from global and domestic supply disruptions are currently exerting upward pressure on prices, as I'm sure you've noticed. Inflationary pressures from strong demand, supply shortages, and high energy prices should subside during the year. So that's good news. Inflation is expected to decline relatively quickly to about 3% by the end of 2022. So kind of makes it sound like they think it's going to be kind of intense for a while, and then it's not going to be as strong as we get into later parts of 2022. They get into more of that here in some of the other parts I've highlighted. A couple things about the global economy. So the global economic activity recovered strongly in 2021. In the United States, the recovery has been robust. You may have noticed if you've been paying attention to some of the news coming out of the United States and their housing market as well. The economy is now experiencing excess demand and particularly elevated inflation. There's a whole bunch of other stuff in this report if you really want to get into the details. I just wanted to give you the highlights. Okay, so this is for about the Canadian economy. So the housing market activity has strengthened again in recent months. It's led by a rebound in resales, so that's resale homes whenever it's not a brand new home sale. Low borrowing rates and high disposable incomes are continuing to contribute to elevated levels of housing activity in the first quarter. At the same time, other factors that support demand, such as population growth, are also now picking up. So it's not just low borrowing rates, it's also people having a lot of disposable income and population growth. So they're going to mention later immigration is part of that. But there's several things driving this housing activity. Here they go into a little bit more about the economic slack being absorbed that they kept talking about. So the absorption of economic slack in the second half of 2021 was faster than expected. The recovery has been robust. This is due to a surge in services consumption, strong growth in exports, and the addition of almost 800,000 jobs since May. At the same time, supply has been revised down since October because of further bottlenecks and shortages related to the pandemic. Businesses have also reported that they increasingly face capacity constraints as they try to meet elevated demand. So that's part of what's causing some of the inflation, is that there's been, like, I'm sure you've heard a lot of people say, supply chain interruptions and problems and whatnot, or you may have gone to a car lot where they sell new vehicles and just noticed that they're like empty, like they just don't have much stock, and a lot of companies are having trouble getting stock for all types of stuff. So when you have low supply and there's a high demand or surging demand, that definitely is going to put some upward pressure on things as well. But they are, if not here, they do talk about how they do think some of that stuff's going to be temporary. It's not going to be an ongoing thing. I've read some economists that do think that the supply chain problems will be temporary, and that a lot of that is due to the pandemic. And as some of those things become less relevant, it'll sort of take care of itself.
Prices for food, gasoline, and housing have all risen faster than usual. We expect inflation will remain close to 5% through the first half of 2022 and then move lower.
Thought I'd highlight a couple things here because it's something everybody's been noticing. This is the inflation that's bugged me the most. So upward pressure on food prices to persist. Yay. As consumers face rising prices at grocery stores, food price inflation is making headlines. Prices for food purchased in stores are up nearly 6% year over year. Certainly feels like more than that, doesn't it? Food categories with the strongest price inflation include beef, bacon, and chicken, up 12%, 19%, and 6% respectively. Maybe it's time to start buying lamb. Breakfast cereals, prepared fruits, and prepared vegetables, up 6%. Potato chips and other snacks and margarine, up about 7% and 18% respectively. So maybe it's also time to switch to butter. It's better for you anyway. All right, let's keep going. So services Price inflation, which is affected by both domestic and external forces, has risen to nearly 3.5%. The increase is led by escalating construction costs due to higher prices for building materials and labor shortages. So this is also affecting the housing market. So if you're in the market to buy a new home right now, at least if you're in the Edmonton area, that's the only area that I can speak to much. The builders don't really have a whole lot of inventory. They do have spec homes being built and they do have some stuff available, but it's not much. And the build times that some of them are giving now are like 12 months and maybe longer in some cases. They've got a lot of uncertainty on when they'll have labor or when they'll have certain supplies. And so they just don't want to promise fast build times. So it's really sort of made it so there's not a whole lot to choose from. And that's also putting upward pressure on prices as well. Because if they're not able to get the houses built as quickly as they need to because of supply shortages and labor shortages, but there's a bunch of people that want to buy, it's just a matter of time until the price just starts to go up. Okay, so this is their section about the consumption-led recovery, and it's more about the housing market. So housing market activity is anticipated to remain elevated but ease from its current levels. Resales should be dampened by the fading of the pandemic-induced boost in demand, reduced support from accumulated savings, and borrowing rates that are now above their pandemic lows. So this is interesting. They believe that resale homes were driven by an induced demand, essentially, from the pandemic. So that's really interesting. And reduced support from accumulated savings. So a lot of people were accumulating savings during the pandemic, and that helped a lot of people save up money for a down payment. Obviously, once the pandemic ends, that won't be as much of a factor. If people start going out and spending money on other stuff too, then they won't be accumulating savings to buy a house. And since borrowing rates have gone up, especially for fixed interest rates, they're not at their all-time lows for the pandemic. Meanwhile, the easing of supply chain disruptions should support residential construction over 2022. So if they get rid of those supply chain disruptions, then that should make it easier to get houses built, right? The resulting growth in supply combined with easing demand should help rebalance housing markets and contribute to a moderation in house price growth. So I'm sure if you're in some of the markets that have been going absolutely crazy, that might be a nice piece of information. In Edmonton, a lot of people, unless they're a first-time home buyer, are still kind of hoping for the market to keep chugging ahead because they like to get some gains depending on when they bought the house. But some of the other markets that are like super hot, it could be helpful for them if they get rid of some of the supply chain disruptions and can get more houses built. Couple more things, we're almost done. So CPI inflation to decline in the second half of this year. So I mentioned this earlier, they do believe that inflation is not going to be as intense in the second half of the year. So as pandemic related forces fade, inflation is forecast to ease over the second half of 2022 and into early 2023. Upward pressure from supply shortages is expected to diminish over 2022. So they don't think there'll be as many supply shortages either. And that, I believe, was what I wanted to share with you from their monetary policy report. So I hope that was useful. I know it was for me on getting to see a little bit what we could probably expect in the housing market a little bit over the next couple months until they meet again in March. I do think with them keeping that variable, well, they're not the ones that actually keep the variable rate low, but them keeping that overnight rate at like 0.25% is essentially going to make it so that the variable rate will stay low. It's not the same for the fixed rate. Those rates have already kind of gone up a little bit, but it could mean that things will keep chugging along here for a while with some more inflation. And then once they meet again in March, we'll kind of see what they're going to do again. But yeah, keep watching. Let me know if you liked the video, if you had questions. Just kind of getting into this type of video content. I do a lot of stuff for the Edmonton real estate market. But I definitely have an interest in kind of seeing what the Bank of Canada is doing and what's going on in the overall economy and how that's going to affect the housing market. So if you like that kind of stuff, make sure to like and subscribe and hit the link in the description to sign up for my email list. And I'll email you when I've got more videos about the Canadian economy and whatnot. So thanks for watching, and we'll see you on the next video.